Do you hope for a large tax refund when you file your taxes each year? This video explains why you shouldn't, and why you should adjust your income tax withholdings so that you avoid too large a refund or too large a tax bill. So let's start by thinking about what a tax refund means. The US federal income tax is a pay-as-you-go system. You are expected to pay taxes at a regular interval so that by the end of a tax year, you have paid all the taxes you owe. When you receive a tax refund, it means that you have paid more in taxes throughout the year than you actually owed. So why is that a bad thing? Well, when you pay more in taxes than you owe, you are effectively loaning the government money at a 0% interest rate. If you instead kept that money yourself, you could invest it. Now you want to make sure that you don't invest money you may need into a high-risk investment. But even if you invest the money into a savings account with a low interest rate, you're still much better off than if you gave the money to the government at a 0% interest rate. Okay, so now that you know how tax refunds work, you may be tempted to try and maximize your tax bill. The logic there is that if you could invest all of the money you earn and wait until the end of the year to pay your entire tax bill, then you could use the return on your investment to cover your taxes. Well, you can't do that because it's a pay-as-you-go system and the government expects taxes to be paid regularly throughout the year. In fact, if you underpay your taxes by enough, the IRS will charge you an underpayment penalty. If you then wait until the April 15th deadline to file, the IRS will charge you interest on your underpaid taxes. There are exceptions to the underpayment penalty, but there aren't many, and it's in your best interest to avoid this situation entirely. Okay, so you shouldn't overpay, and you shouldn't underpay. So how do you get as close as possible to paying the amount you owe throughout the year? First, you need to understand the two ways in which the IRS collects taxes throughout the year. The most common way is through tax withholding. If you work for an employer, meaning your primary source of income is not from self-employment, ownership of property, or other investments, you've probably filled out a W-4 form at some point. This form is used to determine what amount your employer will withhold from your paycheck each pay period and pay to the government in taxes. On the W-4, you claim withholding allowances. Withholding allowances generally refer to situations that would reduce your tax liability. For example, if you have children or you're married and your spouse doesn't work. The W-4 provides a list of the allowances you can claim. Generally, if you are eligible for an allowance and there are no other factors that impact your tax situation, you should claim the allowance. Since allowances refer to situations that would reduce your tax liability, it follows that if you claim more allowances, less income will be withheld from your paycheck. You'll receive more in take-home pay, and the government will receive less in taxes. This means that if no other factors impact your tax situation, and you claim too many allowances on your W-4, you should expect to have a tax bill. The reverse is also true. If you are eligible for allowances and don't claim them, you should expect to receive a tax refund. So what is the other way the IRS collects taxes throughout the year? Well, if you don't pay taxes through withholding, you need to pay estimated tax on your income. This situation most commonly applies if you're self-employed, you own real estate and receive rent from tenants, or you have substantial other investment income like dividends, interest, or realized capital gains. If you owe estimated tax, you have two options for paying it to the IRS. If you owe estimated tax but also have tax withheld through an employer, you can calculate your estimated tax and add the appropriate amount to your W-4 form. Your employer will then withhold the amount you specify and pay it to the IRS. If you can't do this or don't want to do this, it is your responsibility to calculate your estimated tax and pay it in 4 quarterly installments to the IRS throughout the year. The last thing to note is that if you do fill out a W-4 form, and your income situation changes, you can and should fill out a new W-4 form and submit it to your employer. Regularly updating your W-4 will help you avoid giving the government a 0% interest loan or having to pay an underpayment penalty. So that's tax refunds, withholdings, and your W-4. Thanks for watching.